Hello and welcome to my market update. Today I invited Don Pine, longtime CPA of Pine, Waltrip, and McCoy, and to answer some of the home sale questions, especially tax exemption questions that I frequently get that oftentimes leave me stumped. But so today we're going to answer some of these questions. And thank you, Don, for being here. Thank you for showing up and sharing some of your time and experience today.
My pleasure.
So to start with, what are the basic requirements that a homeowner has or has to qualify for either the $250,000 or the $500,000 home sale tax exemption?
A single taxpayer can get as much as a $250,000 exclusion from taxable gain from the sale of a personal residence if held 2 or more years and used as a primary residence.
Okay. All right.
Conversely, or quickly, a married couple can get as much as $500,000 under similar terms.
Okay. So if by chance, is there a partial exemption for either of those parties if for some reason they're forced to sell within a shorter time, prior to 2 years?
Good question. Yes, there is. If a move is necessitated, required because of employment, the government will allow a proration of the 24-month requirement and therefore have a partial use of either the $250,000 or $500,000 exclusion.
Okay, nice. So, and what about the surviving spouse rule? Can the surviving spouse claim the full $500,000 home sale tax exemption?
Yes. A surviving spouse is entitled to the same exemption that they would have had their spouse survived up to 24 months after the date of the death of the spouse.
Okay, so if they elect to decide to sell, let's say a little bit after 2 years, do they have like a stepped up basis number that they can use at that point, or?
Well, if they sell after that point, unfortunately, they're subject to whatever taxable gain occurred on the original purchase price, except for there is a step up in basis from the date of the death of the spouse.
Okay.
So if at the date of the death the fair market value was $500,000, at the time of sale at $600,000, then the gain would only be the $100,000 difference.
Okay. So the other question I often get is how the property's held. If it's held in a trust or joint tenants or community property, do any of the IRS rules change for any of those?
Generally not, although trust can be revocable or irrevocable. Revocable trust and other forms of title do not affect the use of the exclusionary gain. An irrevocable trust, however, is a different kind of monster or animal.
Okay.
It requires some more analysis.
Okay. So more creative thinking. Well, the other side of it is a lot of sellers, because the market, for a while there was down quite a bit, and so they elected to rent their property out. How long before they risk losing that tax exemption that qualifies them for that either 250 or 500?
The 2-year rule is 2 years of the last 5 years.
Okay.
So in the most extreme example, a couple, an individual could rent their property for as many as 3 years if they owned it for 5 years during the period prior to sale, and still qualify for the exclusion.
Nice. Okay. So, and if perchance they go beyond that time frame, what does the IRS use for the basis? Is it the value what they purchased it for?
If they convert it from a personal residence to a rental property, the value of their cost, or their cost plus improvements, is their basis for determining gain or loss on the ultimate sale if they cannot avail themselves to an exclusion.
Okay. So the other question then to follow is this: if they end up, having to take the hit and pay the capital gains in California, what kind of percentage costs are they looking at?
The tax part on a sale would be 20% federal tax. California doesn't recognize a capital gain reduction from their rates, so their tax for California purposes would be whatever their taxable income, whatever the inclusion of that component of their income caused them to pay. The federal tax, however, can even be more if the ultimate minimum tax comes into play, again based on a person's income.
Okay, so obviously it's pretty complex, no doubt.
Unfortunately, it is.
Well, great. Hey, Don, thank you so much for answering some of these questions today. So if people have more tax-related questions, how can they reach you?
650-8310 in Ventura, or on my surfboard.
On your great. Thank you so much. So if you have any other real estate questions, give me a call, 805-339-3516. Thanks.